Hello, everyone. My name is Catalina Miranda, and I'm the Director of Professional Practice at CBV Institute. CBV Institute leads the Chartered Business Valuator profession, Canada's only designation dedicated to business valuation since 1971. With CBVs and students across Canada and around the world, we uphold the highest standards of business valuation practice through education, accreditation, and governance of the CBV for the benefit of the public interest. As a non-for-profit organization, CBV Institute adapts and evolves to advance the CBV profession to the forefront of business change. We're incredibly pleased to have Michael McTaggart with us today, who is a partner in PwC's Consulting and Deals Group in Toronto, specifically in the restructuring practice. We're here today to chat about the impacts that the COVID-19 pandemic has had on restructuring and bankruptcies in Canada, to share some stories and examples, and to look ahead as to what we can expect in 2021. So welcome, Mike.
Thanks, Kat.
Mike is a chartered accountant, a chartered business valuator, a chartered insolvency restructuring professional, and a licensed insolvency trustee. Mike has experience in business valuation, corporate restructuring, and financial distress strategies. He's been involved with numerous restructuring engagements, insolvency assignments, and stakeholder dispute resolutions. His experience includes advising companies with restructuring-related matters and distressed refinancings, as well as operational and performance improvement mandates and value maximization strategies. As a leader in his field, Mike has been practicing in restructuring for 14 years. Prior to PwC, Mike, I believe you also practiced at 2 other Big Four firms throughout your career. Mike's been involved in insolvency transactions of all shapes and sizes across a wide array of industries. He has worked on large global files as well as small local ones. So why are we here today? We hope that with this session, we can provide an inside look at how a CBV can bring their expertise and knowledge to a specialized area of business. And that's helping companies turn around and start fresh. It's another way that the business valuation profession contributes to the financial ecosystem. So Mike, what is restructuring?
Good question, Kat. I think the easiest way to look at a restructuring is, when there's a mismatch between the asset side of the balance sheet and the liability side. In most cases, the result, the liability side has grown bigger than the asset side, and there has to be some sort of compromise to fit into the balance sheet, right? And so, they come on in a number of shapes and sizes. Restructurings, leverage are often a driver of it, failed mergers and acquisitions. And, a lot of these transactions have led to restructurings. Recessions obviously lead to it. Cyclical industries face a downturn, they lead to restructurings, and then one-off stuff. So large litigation claims, or maybe there's a dispute with the government that forces a liquidity crunch. That's essentially, the buckets that these files tend to start with, and that's sort of how they come about.
Okay, sounds good. Tell us a little bit about your history in this space. How did you get into it? What made you interested in the field?
Yeah, no, for sure. So it was back in the day. I was working in the valuations group at E&Y, and there's a big file going on the floor, and it was crazy. There's teams from all over the country would fly in, and they'd go into a boardroom and close the door, and nobody knew what was going on behind that door. And then one day I got tapped and told that there was an important assignment that needed more bodies, and it was in the restructuring group, and could you come help out? So I was totally curious, and I said absolutely. And lo and behold, I got to go behind that closed door that nobody knew what was going on, and it was the asset-backed commercial paper restructuring. And I joined that team, and I don't even remember how many people were on that file, but it was a lot of people. It was a $32 billion restructuring. So I joined it as a manager, sort of an analyst, or whatever you want to say, sort of a line person that's in this assembly line of people doing stuff. And that's kind of how I got my foot in the door in restructuring. It was just literally someone tapped my shoulder. My utilization was probably too low. So get down the hall and get in that room. But no, it was, and once I got involved, the change and the difference in the work, the cadence and the style, and, putting out fires in the crisis and the hands-on experience, it was addictive right away. I gravitated to it very quickly thereafter.
Yeah, it fits with your personality. So let's talk a little bit about what happened last year. Obviously, the economic conditions resulting from COVID-19 were expected by many to result in quite a jump in insolvencies in 2020. This seemed to be unavoidable, but what actually did happen in Canada?
Yeah, it was fascinating. I remember this time last year, we were ramping up our restructuring group. No one knew what was going on, right? No one really had, a clear vision of what was happening. But the economy essentially shut down in a matter of days. Everyone was working from home. There was a stay-at-home order. We're going on to our third one, I believe, now in Ontario this week. And so, we all thought, like anything, there would be massive repercussions in insolvencies. And like going into it, I mean, the M&A markets were pretty hot. And we did, like right out of the gate of COVID, we saw a number of insolvencies, and we were extremely busy last year from like early March into the summer. But it was a lot of stuff that was sort of on the periphery that was about to go into insolvency before the pandemic hit. So we all of a sudden got this injection of work, and we thought, oh wow, this is, don't burn out. This is what's going to come. It's going to be chaotic, and we haven't even seen, any of the companies that are being shut. What happened, in hindsight, was the exact opposite of what everyone thought. Consumer insolvencies, the OSB puts out statistics, those declined substantially. The government subsidy programs got into the system, and a lot of capital started getting deployed. And lenders were very patient and lenient, and a lot of things happened that, created sort of a bubble around the insolvency issue. And we didn't see as many filings. And then everyone started pushing the date back. Oh, it's going to be the fall. It's going to be January. But we're here now a year later, and we haven't seen an onslaught of insolvency filings or distress fueling from the pandemic. Now, we do have a number of theories and theses about what could be going on and what could be happening or when you're going to start to see that. Some of the private equity clients I talk to, they're actively monitoring companies they think that are using leverage. They're borrowing to cover operating deficits. They're saying, hey, it's only a matter of time before you can get away with that, right? You're not using debt to do capital expansions, M&A. You're using it to patch holes in your operating cash flow shortfall, which is probably not a smart long-term solution. There's a lot of people that feel that once the government wage subsidy subsides, that once that's done, that there's a lot of companies that have now become dependent on it, are relying on it for their liquidity needs. I think the most interesting sort of thesis I've heard, regarding the pandemic and when it'll trigger insolvencies is when we all get vaccinated and go back and there's a sudden onslaught, is there a working capital need? Because a lot of these companies have gone down to, they're idling right now. So they're not deploying staff. They're not using, supplies and inventory and whatnot. So working capital demand isn't quite there, and they're sort of just humming along. But all of a sudden, when your order book goes right back up, do you have the liquidity, the availability to facilitate, your order book? And could that create a liquidity crunch or working capital crunch? And so that's a more interesting one that I found quite fascinating.
So you look at, unemployment, it's up. Consumer confidence is down. Tens of thousands of businesses have permanently closed, and others are barely holding on. Are we saying that there's kind of like a delayed reaction, and what other factors are at play? You mentioned government support programs.
Yeah, I mean, like I had a client last year, a banking client that had a customer. Well, special loans guys don't really have customers, but anyway, they had a client with the bank that was in special loans. It had been in for 2 years. It hadn't turned a profit, this company, in 2 years. COVID hit. His immediate reaction was, oh, this is going to be bad. This is going to be a shutdown. This thing hasn't been profitable in 2 years. He gets the results in June for April and May, once the government wage subsidy kicked in. The revenues had declined 50%, but the business actually turned its first profit in 2 years. I don't think that was the intended consequence of sort of what the programs were, but there's anomalies out there where this has created, opportunities for some to get through and survive. But others, are probably struggling. And, there's a lot of patience in the system right now to help people get out the other side. but it's very unpredictable to see what's going to happen with respect to it. I mean, we haven't seen an aviation industry insolvency, right? Hotels, tourism, restaurants, like my dry cleaner's still there. I don't know who's going, but they haven't closed the shop, right? So you're wondering, I haven't been to the dry cleaner. I mean, I've had 2 haircuts in a year, a puppy and a Peloton. I'm pretty much par for the course, and I haven't been to the dry cleaner. So I'm wondering, well, how are they paying their rent? How are they keeping the lights on? Hydro still comes, taxes still come. There's a lot of stuff around that, right? Rent. And so it's very curious to see how it all kind of unwinds. I kind of do feel like we've been in a bubble for a year.
Yeah. It feels like a big giant pause button. That's for sure.
Mm-hmm.
What other notable trends have you seen in bankruptcy activity during 2020? I mean, is there anything to comment on there?
Yeah, I think one of the areas that is actually interesting for those that want some technical information is it really there's a transaction that we're starting to see a lot of in insolvency, specifically in the cannabis space, called a reverse vesting order. And that's very unique. So if you think of a traditional receivership sale or asset sale in a bankruptcy CCAA context, we often get a vesting order. And so that's at the end of the day, the assets have been sold, the buyer's got the assets. They buy the assets free and clear of any of the liabilities that were associated with them. So they get a vesting order, vests out, it basically takes all the liabilities and strips the asset and gives it to you clean, free and clear. What started happening, and it's happened on a case called Stornoway Diamonds first, but then last year I was on a file called Wayland. It was a cannabis file, and we were getting towards the end, and there was an issue with, you can't sell a Health Canada cannabis license. So what the lawyers came up with was to use the reverse vesting order to basically vest out all the liabilities of the company to leave the shares clean. And so they use this reverse vesting order because it's not getting rid of all the liabilities and giving an asset. It's stripping everything except for the assets you want to keep and the equity, and selling the shares, because then it was a change of control that Health Canada could approve and thus facilitate the transfer of the cannabis license. So that transaction is being used multiple times now, and it's kind of the way they're doing things in the cannabis space. So it's interesting. I think it fits very well for cannabis, given the loopholes around having those licenses in place and how you can transition them. But it'll be interesting to see how people start to use that transaction structure in more and more insolvencies as they pick up, because essentially what it does is it gives you access to the equity of the insolvent company. And that never really was a consideration before. You'd always buy the assets. Why would you buy the liabilities? The liabilities are associated with the equity, right? Yeah. And in a reverse vesting order, you've essentially cleanse the equity so it can be transferred. So it's a very interesting transaction, and you're seeing quite a bit of it. And I definitely read up on it and watch it. I think from the valuation standpoint, I'm sure there's going to be, what's the value of the equity, the license associated with it. There's a lot of interest around that. So it's a really neat topic if you're going to follow anything in insolvency, to just kind of pick up on that one.
Okay, interesting. And I know Forever 21 was another big one that took place recently. Were you involved on that one?
Yeah, we were the monitor of Forever 21. So, that's another interesting one where, I think the last couple of years for insolvency professionals, the 3 industries that have sort of kept everyone busy have been cannabis, energy, and retail. Those are sort of the 3 that have driven most of the transactions over the last number of years. Forever 21 was, it was a very interesting file. It was a retailer, obviously, and it was a liquidation, and it was, it was very surprising, how quick these liquidations occur and happen now in the retail space. It's a very, unfortunate, situation with respect to that industry. It's, in the U.S., it's much more predominant how many retailers have gone insolvent. So you see the shift from bricks and mortars to online sales, and with that one, you had disposable fashion, so keeping up to date on inventories, because what's in style today is out in a month from now and whatnot. And so it's cheaper fashion and keeping up that turn. So it was an interesting case study to watch, and that one had a very unique story behind it. But that was definitely one of the bigger retail files we touched last year.
So obviously the environment within which a financially distressed corporation has to operate is going to be vastly different from an ordinary commercial activity of a business. If we just step back, maybe take us through what's involved in a restructuring. How long does the process take? What does it cost?
Sounds like a client, Kat, asking me to pitch. No, it's those are good questions, and really it is tailored to each situation, right? Each restructuring. What is it? Well, we kind of went over that. It's when the capital structure really doesn't fit anymore, or there's a one-off event that's driven some sort of crisis that you need a stay of proceedings. You need a shield around you. And when I'm talking about this restructuring, I'm talking about a CCAA or a proposal. The difference is those are debtor in possession, so that means the company still manages their affairs. They're just under supervision of the court, right? When you have a bankruptcy or receivership, a court-appointed officer, a trustee, or a receiver is put in, and those are often liquidation events. A bankruptcy is a court-ordered liquidation. So how does it start? Usually there's a triggering event, right? There's a looming debt maturity, there's a liquidity crisis, like payroll's due, or there's a tax assessment or litigation gone wrong. There's something that sort of triggered the event. And so what happens is the board meets and the senior officers of the company, and they have advisors. And this is where the lawyers are involved. The lawyers are very instrumental in the process. And they lay out the options, because when directors and officers start to get into that zone of insolvency, it becomes quite risky, right? Because you can be exposing yourself to personal liability, other issues that, fiduciary duties. So lawyers are often very early in on the scene, and they're helping guide the strategy and the process of what's the most appropriate. So then if you're talking about a CCAA, which stands for the Company's Creditors Arrangement Act, which is, hey, I'm going to fix the business. I'm going to, we always say, are you going to fix it, flog it, or fold it, right? So fix it would be a restructuring, flog it would be a sale, fold it would be a liquidation. You start to develop your strategy. So a CCAA, you go to court, you get an order. They can take, prepackaged files, I would say, depending on what your strategy and what you want to do, some say 90 days, so 3 months, but that's very tight. I'd say most transactions are about 6 months, and they can go up to they can take multiple years, right? It really depends who the stakeholders are. If there's multiple, unions and environmental considerations and the sales process, so part of your plan might be selling assets. If that is going to take, 6 to 12 months to canvass the market and market that asset appropriately so that you get the maximum recovery for the stakeholders, being the creditors, then you're probably in for a longer run.
Yeah.
And obviously the duration dictates the time, right? So that's probably a good way to look at it.
Okay. And you mentioned legal advice. What kind of other expertise do you typically need in a restructuring file?
Yeah, so a lot of the times, depends. A lot of the times there's an M&A banker or a broker, right? Because most of these transactions result in a sale, right? Like if somebody goes insolvent, whether it's a liquidation or a CCAA, there's usually a sale component to it. Lawyers are instrumental, bankers are instrumental, lenders, right? So a lot of the times when you have this file, that's great. But if you gave me a call on Friday afternoon saying you're going to miss payroll and you want to restructure, you want to fix the business, it's going to be tough. So usually what we have is a debtor in possession financing. So where we go to court and we get a charge that comes in first place above the senior secured lender. That's called a DIP loan. Often the senior secured lender will opt in and say, hey, I'm going to do it because I don't want someone coming in ahead of me. But there are lenders out there that provide those loans, and those guys finance the process. They finance the restructuring. So lenders are involved, valuators all the time. So I don't know how many times when, I've been in a file and the question is, well, what's it worth? Okay, well, we do a liquidation analysis, always do a liquidation analysis. And then there's going concern assumptions, right? So we try to think of it on an enterprise value basis. And so we actually do use valuations quite a bit in the sense that I whenever I'm doing a bigger file that has a lot of different sort of notes or structures in the capital structure. So you have senior notes, unsecured notes, and maybe trades. What we do is we'll do an enterprise value analysis, and we'll just do a waterfall. And you're trying to figure out, where does the value break? What's the fulcrum security? Where does, who's getting compromised in this transaction? The secured is probably fine. They're covered because, on a going concern basis, you could sell it for 5 times. The enterprise value is enough to cover them. But as you start to get into the unsecured and the trades, there's going to be a value break. So evaluators, and then forensics. Forensics, a lot of the times in insolvencies and bankruptcies, when things don't go so well, the inspectors who give direction to the trustee, who's the court officer, will ask for a review of transactions that went on before to see if there was any preferences or, assets were sold, friends and family, like those kind of things that, would warrant a review and a reversal by the court. So we'll get forensics involved in that sort of stuff as well. So everybody, on a big file, like, you look at some of the iconic files like Nortel, Air Canada, I would say literally any transactional professional was involved in some capacity or another, right?
Yeah.
We use our IT guys all the time to back up servers. So that was sort of like, one of the things in the last decade that you've seen a lot of is all of a sudden you take possession of a company in a bankruptcy, like where's the data? Where are the records? They're on the cloud. How do you get them off? What if the employees aren't there? They all walk out. Like, the whole IT environment. So you got to have a couple IT people on speed dial for sure.
Yeah.
Yeah.
So you mentioned the capital structure. Over the years, have you seen any change in how companies are structured? Is there any interesting capital structures you're seeing now, or any point at which that common break happens?
Yeah, no, a number of years ago, one of the things we were looking at, because I do a lot of prospecting, so I do a lot of modeling and sort of looking for, distressed opportunities. Where do we think, what sectors, what companies do we think are, ripe for some sort of informal? So maybe they want to do it out of court or in court restructuring. So we do a lot of work. A number of years ago, a lot of success in looking at broken convertibles, right? Convertibles were very hot in the Canadian market. There was a number issued. So that was something where, we were watching to see, did the equity price drop to a point that the conversion would completely dilute the shareholders, right? Yeah. And then in more recent years, there's been a lot of covenant light stuff. And so what I usually pay attention to now, the things that kind of get my attention are, covenant light, unsecured notes, stuff like that. Like you're seeing, dividend recaps from private equity funds. So they'll buy the company, they'll run it for a few years, and then they'll leverage it up, dividend the money back to the sponsor, and then the company's got the debt on the back end. I've seen a few of those that are quite interesting because, you wonder where's the capital coming from. A lot of it's coming from the US. So you'll see unsecured notes that are on a balance sheet that were there to do a dividend recap, which puts a lot of, it can put a lot of pressure on a balance sheet, right? Because it creates a debt. So, I find that, quite fascinating when we start to see those kind of structures. And then also, in the last 10 years as well, there's been a lot of sort of asset-based lenders coming up from the US, a lot of different types of loans you can get now. If you've been to any of sort of the Turnaround Management Association events, there's always people from various shops. A lot of independents and boutiques have started up where, they'll lend into situations where the banks, the traditional charters in Canada just won't go, right? So you've got guys that'll do specific lending on inventory and receivables, or they'll go into areas of the market that the big banks just don't want to go. Their risk premium isn't, profile isn't there. So there's a whole sector of lenders out there that just do special situations type lending. And so I find that's quite unique now and really evolved in the last decade.
Okay. And so, we're at historical low interest rates. What type of leverage levels are you seeing now versus before? Are there any examples that, potentially concern you?
Well, see, I don't really look at leverage multiples as much as I look at interest coverage. I look at, debt over EBITDA. I look at sort of cash flow from operations. I look at, sort of more of the vital signs, if you want to call them that. Yeah. But yours definitely, like I talk to my private equity colleagues and they tell me, they're frustrated because, I think one of the senior guys in the PE industry put it to me best. He said, the multiples down the fairway are so high that they're finding that they're getting outbid on stuff, so that they started to look in sort of outside the fairway. So if you look to the left, you could either go after something that's really high growth. So, you're paying a high premium, but it's, you're shooting for a Google type return, a Shopify. You're looking at those like super high growth. In the fairway where they used to play, the multiples are so high that they're finding it difficult to justify the IRR they would need to pay that. And then on the other side, you've got distress. And so they're saying if there's the right distressed opportunity, that they could then bolt on to a platform operation where they've got a strong management team already on a portfolio company, that's where they would play, and that's how they would get the returns they need. But that's what I'm hearing in the market from sort of multiple levels. When I look at interest coverage levels, it often surprises me. Pick your number, of what is appropriate for interest coverage or debt to EBITDA. There's a lot of companies that are well beyond what I think would be acceptable from the way I look at the world, but seem to be just completely disregarded. Yeah. And so one of the ones I always look at is, interest coverage, right? When you start to get around under 2 on interest coverage, I know it depends on the industry, but when you get under, when you're hovering around 1, you're basically saying my EBITDA, so my proxy for cash flow, doesn't just barely covers my interest payments, my contractual obligation interest payment. That doesn't account for maintenance CapEx, cash taxes. We all know, the accountants know that EBITDA is driven off of accruals, right? So have their AR being collected that generated the revenue. So you know what I mean? You're pretty close to a fine line. And again, just run this Cap IQ search and see. There's a lot of companies hovering around 2 and below that I thought there would be a lot more pressure on, but I haven't seen it, to be honest with you, Kat, which surprises me.
Yeah. Yeah, interesting. We'll watch and see. We know that COVID-19 has had a particularly profound impact on oil and gas, energy, manufacturing. You mentioned trade. I'd throw construction in there as well. What is your perspective on the industries that you're watching in the post-pandemic era?
Yeah, obviously, the industries that are driven by consumers, that, you look at retail, I think, it was already under pressure. Everyone now having to rely on their online model, capacity restrictions at malls, shutdowns in our largest geographic centers like Toronto, huge pressure, right? Restaurants, hospitality, entertainment, travel, tourism, all of those are massive pressure. And it's funny because we really haven't seen, anything hit the tipping point in that. No one has had to, say, hey, we need to restructure yet in that regard. There's obviously smaller ones, I think, that have been driven, but nothing, seismic in nature. So those are things we're watching. Those are the industries that my assumptions, my thesis would be they were hurt. I honestly thought that one that I thought that was going to get a lot of pressure after this time last year was long-term care. I thought that, after the first sort of, tragedies that went through the industry with COVID, I figured that there would be a lot of, already a highly regulated industry. I figured that there would be a lot of government regulation on top of that and making it very, very difficult to make money if you weren't at scale in that industry. So that was one that I think that I would still keep my eye on, because when we come out the back end, I'm going to make the assumption that there's going to be a lot of investigations and recommendations as to why was the pandemic so particularly, hard hit in long-term care homes. So that was an area that I thought might have been a bit more, but that's probably something that's further down the road once the dust settles and they go back and sort of study and say, okay, well, why was it? Lessons learned, right? And then you say, okay, fine, government gets involved, the layers of compliance and thought, which is probably very appropriate given, these tragedies happen, but does it create an added cost that makes it difficult to operate under certain models, right? And so that's one that I've had the conversation with a few distressed investors and funds about that, saying that this is an area where I wonder if there's a long-term, implication on that.
Yeah. Oh, good point. What about condo developers? It seems like that's still going strong, at least in Toronto and other major centers.
Yeah, no, that's a good question, Kat. We just actually finished, or just wrapping up the sale of 33 Yorkville, which was a receivership that did happen during the pandemic. It was interesting. That file was fascinating because we worked with the top brokers in the country from the real estate side, and we're around some of the largest lenders in the space. And I think there's a lot of positive optimism for, real estate in Toronto and in Canada in general. I mean, you look at these housing and bidding wars going on right now. It's pretty crazy right now. Like, I mean, last year this time the government enacted mortgage relief, thinking everyone's going to throw the keys in and walk from their home. And here you are now, where people are paying, $300,000-400,000 above ask in a suburb. It's insane, right? One of the things I learned on 33 that was very fascinating was, the influence before the pandemic that foreign buyers had in the Canadian marketplace. So, when immigration virtually stopped and the borders closed, the brokers are saying that would have an impact on buyers, and that would have an impact on, developers and whatnot because of that inflow. I think it's a very valid point, right? But we really haven't seen it because of everything that's gone on, in the housing market right now. Like, you've got record low mortgages, you've got people outside of just buying a house, like the home renovation market, right? Like, you can't get lumber, you can't, you can't get a TV, right? So in theory, I would have thought that, countries in a pandemic, everyone's working from home, a large, portion of the workforce is on some sort of subsidy program. A lot of, companies are drawing on government programs to maintain liquidity. But on the other side, you've got this very, very robust housing market, which you'd think the two would intersect at some point. So I'm pretty confused, to tell you the truth. But it seems that a lot of people are optimists with respect to Canadian housing and obviously condos into development.
Yeah. So finally, just to wrap up, tell us, how does being a CBV, has it helped you to be a trusted advisor in this space?
Yeah, like I said, so I got my CBV, like literally the ink was just drying when I got my diploma and had literally moved into restructuring. And it served me phenomenal throughout my entire career, because there's always a question of what's the value, how much is it worth? As I got into restructuring and, going concern values and transactions were always the, part of the equation, I quickly understood what the bankers were saying or what the M&A professionals were saying, because I could follow. I know what an enterprise value is. I know what a WACC is. I know what a discount rate is. I know what, normalized earnings is. I understand how a debt waterfall works to get to equity value. Like, I'm pretty well versed in that. And so that foundation has been so critical. And one of the areas I've really started to focus on in more recent years is advising, hedge funds, alternative investors on distressed investing strategies. And so knowing the valuation equation is alongside the technical accounting side, or technical insolvency and accounting side of things, has been phenomenal to help bridge that, right? Because a lot of these investors will know the one side, but they don't understand how all these unique rules around priorities and transfers and whatnot in insolvency correlate into my valuation equation. So it's been a phenomenal tool to have in my back pocket for sure. It really was what got me into insolvency. I told you guys at the beginning that I got called into this ABCP file. Literally, I was a body to fill some space and probably stuff some envelopes or whatever for a mailing. And then one day we were all trying to figure out, what credit default swaps were. And I remember having been over at Bloomberg for training when we were doing our CBVs, and we had to go over there to learn how to pull WACs and all that stuff. And they showed how they had the CDS pricing. And I remember there was a whole room of people upstairs in Montreal working on going through these credit default swap contracts and trying to plug it out in Excel. And I remember coming downstairs or coming back upstairs and like, oh yeah, I just punched all the ISINs in on Bloomberg. Here's the pricing. And they're like, okay, you're on the team, right? Then you can go run the Bloomberg for the next, 9 months. So, yeah, but that was really a skill that I had from valuations, because I knew at that time we were starting to look at credit default swaps as a proxy for, default risk, debt values and stuff. And I've always kept that with me. Like, I love that technical aspect of the CBV and what I learned in those years, and, learning how to pull comps on capital IQ and do it properly, and just leveraging that knowledge. And I've always kept up to date on it and being refreshed on it, because that core competency has helped me so much. And as I progressed as a restructuring individual, what really I gravitated towards was the pursuit of, looking for, using data analytics, using machine learning, try to figure out where the next distressed wave will come. And we run a lot of models on public companies and, other methods of text analytics and whatnot to derive target list. And I would say the fundamentals of just walking in and being comfortable with that research, or someone providing that research, is that I was trained in that field, way back when I was doing my CBV. So for me, it's been instrumental in developing the kind of work that I like to do. Right. I really like that kind of work. I love the unique stuff like that. So
Fantastic.
Great.
Fantastic.
Yeah.
Well, thank you very much for your insight today. Really appreciate you chatting with us.
No worries. Thanks, Kat.
I think this talk today has further underscored the many ways in which CBVs are involved in value creation, value protection, and value maximization. I think we both agree that CBVs are viewed as essential to informed business decision-making. We're leaders in our fields, as well as trusted advisors. So thanks again, Mike, for your time today.